Okay, welcome you guys. It is November 30th, and we are going to be doing a little bit of a longer version of the class that I did for Trade Giving, which was Trade Thirsty's event on Black Friday. So I had a lot of people that obviously weren't able to make it that day just because it's, well, day after Thanksgiving. A lot of people still celebrating or out doing their crazy shopping, although a lot of people seem to be doing more of that online these days. I know I went out and did my crazy Black Friday shopping just across the street at the pet store because we were out of fish food and nobody was there. So I guess Black Friday events at fish stores maybe aren't as exciting as other places. I don't know. But anyways, we're going to do a little bit of an extended version here tonight. And if you have any questions, please put those in the questions box. You can see that on the menu, the drop-down menu. You might have to click a little triangle to open it up so that you can see everything. But there is a questions box there. And let's see, first question, of course, is tonight going to be recorded? Yes, and I will be sending that recording out to all of you guys that are registered here tonight so you can review the class. Let's see here. I think that all of these other questions we're going to keep for later. So if you have anything else, just go ahead and we will get to your questions as soon as we wrap up the class. All right. So all of the charts that I'm using today are provided by TradeStation. And tonight's lesson, we're going to look at a number of things as they're related to trade management. So we're going to look at how to limit losses on underperforming positions by using the correct stop and trailing stop techniques. We're going to be looking at how to accurately time targets that are going to hold with near perfect timing. And I'm actually going to show you a trade from last week as well as something from today. We're going to look at how to avoid being flushed out of winning positions, how to hold on to winning positions longer, and how to time upcoming corrections. So the first step to proper trade management is making sure that you are taking the correct entry and stop placement in the first place. Obviously, if you're not timing your entry and stop the best you can, then you're going to have a lot of trouble really getting those successful trades where you're making more than you're risking. So with a lot of clients that I'm working with on one-on-one basis, this is the first thing we end up working on them with, is how to make sure that they are taking the most ideal entry trigger. And what happens is that sometimes your entry is not your most comfortable place to enter position. The ideal entry is not always the most comfortable place to enter position. So a lot of traders are used to using techniques like trading a channel break. So a channel breakout, for example, if you're using an entry trigger on a channel breakout, a traditional breakout would be using a break from the upper end of the trading. And when we're taking this type of traditional breakout, usually your traditional stop is also going to be on the lower end of the trading range or the trading channel. Now, this is the technique that traders will use whether you're looking at taking a channel breakout like you saw here, or if you are looking to take something like a bull flag, a bear flag, the handle of a cup with handle, pretty much any type of channel breakout strategy, when you use that type of strategy, you're really placing yourself at a disadvantage. So the key to using the most ideal entry technique is often to use the multiple time frames. So when I'm looking at a strategy and looking at a trade, I'll usually have something like, let's say this is a 60-minute chart. And I'll be looking at a base or a period of congestion that's forming on the 60-minute chart and say, okay, you know what? This looks great for a continuation type of move. Usually I'm backing up that by looking at a weekly, sometimes a monthly time frame, and confirming that those also are in favor of an upside move. But when it comes down to the actual timing of an entry, I'll usually drop down to something a bit smaller where I might not see the strategy as clearly, but I can see the waves of development that take place back and forth within the trading range or within the strategy itself. And so when you're looking at traditional entry triggers, typically you'll see things like connecting the highs within a channel and using that as the breakout. So that would give a traditional entry about here, and a stop is usually under the low of the entire trading range. Now, what you run into with this is that when you're looking at target levels and how to place targets and what to expect on a trade, oftentimes it's going to be pretty limited compared to what your stop would be if you're using this type of traditional breakout. We'll look here in a few minutes about, how we would place a traditional target on this type of setup, but basically that target zone would be up here. So when you're looking at entry versus stop versus target, you're looking at a 1-to-1 ratio, sometimes even less. It might even be like 0.75 to 1. And the trouble with that too is that when you take this type of a breakout, you'll notice that this broke the upper end of the trading channel and then it pulled all the way back in. Now, sometimes that pullback can break under a previous low. So a complaint that you'll hear from a lot of traders, it's something that I had to go through a lot when I was first beginning to trade, and is that you'll get flushed out right before it turns back around and does exactly what you were expecting to do in the first place. Usually that will happen with a two-wave pullback. So you'll have an initial pullback and then you might get a secondary pullback that will just flush out your stop. And then it will turn back around and head back the direction you were expecting in the first place. Has this happened to any of you guys? Sound familiar? Yes, a number of you. Yeah, I think it probably happens to most every single trader out there at some point in time, especially when you're just starting trading. Now, when we look at altering these entries and a stop placement, we can get a lot better return on what our risk is. So I'm going to show you a trade here that's what took place in the euro dollar here not too long ago on the 24th, where we had a trading range breakout. And I was stalking this breakout from pretty early on in the trading range, and it wasn't the most ideal strategy for a breakout. There was a lot of sloppiness back and forth going into the trading range, but that's the thing. Most of the setups that you're going to be trading aren't going to be picture perfect. They're not going to look like what they look like in a textbook. So you're going to have to think, okay, where's my risk going to be the most profound? And where are places that I can actually limit that risk and take something that might be a little bit of a more ideal setup, even if sometimes that means waiting for something a little bit later on. So this was a trading range that was taking place in the euro dollar on the larger time frames. I'll show you that here in a minute. But it was a little bit sloppy going into the range. There was a lot of back and forth over here. And you can see within the range itself that when you're looking at the trading channel and what was happening up here, if we had just connected these highs, we would have had entry triggers in here where it broke out to new highs, but you'll notice that that didn't get the movement really going. It didn't allow for strong follow through on the trade. And instead, it fell all the way back in here. And you can easily see many scenarios in which it would pull all the way back, break through a previous low that would be a traditional stop, only to just turn around and look at how quickly that took off again. It offered a second traditional entry point here where it did go, a decent amount, but what you'll see here in just a second is it wasn't able to continue with that, because by that point it had to rally all the way from the lower end of the trading channel through the resistance at that upper end of the trading channel, and then try to attempt to do a continuation at that point. So I didn't take the trade when this was happening. Actually, I was just barely waking up at that time when that happened. But what you'll notice is that when this continued to develop here, I'm going to switch slides here, and we look at this, you'll notice that it pulled right back into the channel. And this is really typical when something is moving from the lower end of a trading channel to the upper end of the trading channel. It happens when you're looking at bull flags as well as bear flags. So you will see this back and forth type of action. And if it's coming from the entire lower end of the channel all the way up to the upper end of the channel, even if it manages to break the channel, a lot of times it will pull back into the channel. So this causes several issues for traders. First of all, it might not be quite ready for, a solid continuation. It might pull back again, break that previous low just enough to trigger a stop and then get going. Or also you'll have a lot of traders that will, for example, move their stops to break even, especially in a scenario like this, where when you're looking at that channel break, if you took an entry trigger here and your stop is under here and you're seeing things start to slow up here, then it might be harder for you to say, you know what, I'm going to give this more time. Yeah, I might give back all the gains that I have. Like, let's say you were risking $100. This is up 75. You might say, oh my gosh, I don't want to take a potential loss on this now already, and move stop to break even. The problem with that is that this zone of congestion is a major support level. So you would actually be getting out of a trade right as it is hitting support. So this is not the type of setup that is ideal. It's something that's going to give you a much higher risk, and it's going to be more difficult for a lot of traders to manage. Now, once you're more advanced as a trader, then you might make exceptions and say, you know what, I'm going to start to build into a position. So let's say I had seen this just before it was triggering. It was actually triggering right when I saw it. I got up just before 5. And what you'll notice is that some of these I will say, okay, you know what? I want to get into this, but I don't really like where it is here. So I'll take part of a position, keep the wide stop, and then try to add on to the position a little bit later on, just in case it doesn't offer a pullback. Now, in this case, there was a nice opportunity for that continuation move. And that also offered a better area to go ahead and place a trade that had substantially less risk to it. Because when the euro dollar pulled back in the morning, we started to see that initially it offered a pretty solid fast pullback. So it had this triangle up here, and then it had a little two-wave congestion, and then two-wave move down, initial move, secondary move, and then it started to shift momentum. And this is where we start to see these more ideal setups happen before you get a traditional entry trigger. So the traditional entry trigger on this channel break, which is the pullback that we saw on that previous chart, is to take this zone and take an entry as that channel breaks. Now, the first thing you'll notice is that when this happens, a lot of times you get these really rapid flushes to the upside, because this is where a lot of people had their entries placed. And it's very easy for something to move very quickly, but it's difficult to get filled at a decent price there. So if you are late on a trade and you do miss like the ideal entry and need to get back in, or need to get into a better entry, then you can go ahead and look for things like little pullbacks to that channel that would be that typical, break even stop level that people are looking for, and buy into it on the pullback like that. But the more ideal entry is when you start to watch these pullbacks in the first place. There's several things that can clue you into it being an ideal setup that is developing. So the first thing that you must look at is you have to have momentum in your favor. So this is that second important step to trade management. And momentum is basically the rate of change in a security. How quickly is price changing over time as compared to how it did in the past. So when we're looking at things like trading channel breakout or trading range breakout, any type of strategy like that, even reversal trades, and I'm going to show you guys a reversal trade here a little bit later on that happened today. Even reversal trades, the momentum is so important because it will really make or break a trade and determine what that risk is going to be on the trade if you take it. So if momentum is in your favor, then you can get a really, really nice trade coming out of it. So an example of this is when we look at this pullback here. We want to see pullbacks that are more gradual compared to average moves. So an average move would be when you see these V formations happening, like in here. Even this one, you're going up to this high here. Then the back and forth action like that is typically what you would consider to be average in that security. And so what you would want to see to reduce your risk on a trade and give you a better trade and more easier management on a trade is to look for something where the momentum overall shifts. Now, you might have these little spikes where momentum might be a little bit stronger one way or the other, but when you look at transecting the entire channel, you want to see momentum that is more gradual than the previous move. So this more gradual pullback into the support right from the breakout serves as two pros for a continuation move on the breakout itself. Now, let's go on and look at this a little bit on a smaller time frame here and look at how those entries can take place. So when we look at this momentum shifting, the first thing you'll notice here is that initially, as the support hit, it hit pretty strong, but it reacted just as quickly. So this created a really deep V formation. When it went back down again, it had that same momentum to start with, but then it began to shift. And that shift is where things become really important because even though it went and hit these lower lows, it really struggled to do so. It bounced back and forth off of them several times. So this actually created a strategy that I call a momentum reversal. I know most of you guys, if not all of you here, are familiar with that strategy because it's something that I trade all the time, and it's by far one of my most favorite strategies, and it's really easy to teach to newer traders. So that's why you see it all the time, and I'm actually going to show you another example of it later on here because that's the trade that we had today. So with this momentum shifts, though, it gives you the opportunity to take a much smaller channel break. So this strategy overall here, exactly, it is a 2B. So it has the slightly lower low, where here's the first low, here's the second low, and then in that second low, you have a momentum reversal. So momentum reversal strategy looks like this. You have three lows, you usually want these V's forming, and you're buying coming off the third low. Now, the ideal entry trigger on that is to take a channel break coming off of that third low. But when you're dealing with a 2-minute time frame, it might be a little bit tricky to do that. Now, usually if I'm entering on 2-minute time frames or smaller, I'm going to be using a tick chart so that I can see the back and forth movement a little bit better. But this one, you might have had a little bit of a harder time just because it moved a little bit quickly coming off of that third low. So second choice is to take that channel break. Now, on a traditional momentum reversal, you wouldn't really want to take that channel break because it wouldn't give you the best odds overall. But when the momentum reversal is just a tiny little pattern that makes up a much bigger pattern, it's okay to take that channel break on the smaller. Of course, you can always drop down to a smaller time frame to get an even better entry trigger, which would be even more ideal. But there gets to be a point where you can't go too much smaller. So that entry, though, using this smaller momentum reversal within the 2B, which is the little bit the larger strategy, which is part of this overall breakout strategy, is really giving you three strategies all setting up at the same time. And you can take that smaller break. And what then happens is that you've got an entry and a stop that is about half of what it would be if you took a traditional channel break and a stop. So what this means is that when you are taking the trade, let's say you enter with 10 contracts. Well, you're able to enter with 10 contracts on a traditional channel break, but if you took it using this smaller channel here, you might be able to enter it with 18 to 20 because you're looking at a little bit more than half of what this range is. So you could take a lot more contracts and you're still going to have the same target levels as you would. You just now have a substantially larger position that you can hold on to without any more substantial risk. Your risk is exactly the same of it stopping out, whether it breaks here or breaks here. And this is going to be the case in most of these trades. Now, sometimes there might be a little bit higher risk in taking the tighter strategy. That will have to do with time development, which we don't have too much, interestingly, we don't have enough time to get into today. But there are specific places in a pattern development that time-wise are ideal for taking a trade. So when you're looking at that, then sometimes your time development might not be perfect, which would be giving you a heads up that your entry might be a little bit early. So you might have the risk of another pullback into the range. In this case, that's not something that happened. But that is something that, for those of you that are in my boot camps, it's something that we've talked about quite a good deal. Now, here is the chart that shows you these two entries. And then there's also the advantage of having another entry based on the smaller time frame. So if you do miss the first one, you can always look for these secondary pullbacks and sometimes even the third pullback. We saw that when that channel broke, it actually pulled back into the channel over here. So sometimes if I miss a channel breakout, just like on the bigger trading channel, I'm watching to buy that pullback. And you can do the same thing on the smaller time frames as you would on the larger time frame. So on the larger time frame, we're buying this pullback. On the smaller time frame, you could have also bought the same pullback. So here we have a Phoenix, which is the first continuation move. And that gives you an even tighter stop. So if you thought you were maybe a little bit early with the 2B and the momentum reversal, this would be a location that you could add to the position as well as tighten up your stop. So this would be ongoing trade management. And usually what I will say is that you do not want to adjust your stop until you see the previous high break. But if you have an additional strategy that developed, like a Phoenix, then that can be an exception to the rule. That can be a scenario where you can tighten up the stop a little bit faster. So this offered a secondary entry. My entry was based on the first one. The second one offered just a good continuation for anyone that might have missed that. Now, when we go further and look at trade management, the third thing we need to look at really and pay a lot of attention to are impulse moves. Now, impulse moves are those major waves of price action in the market. So when we're looking at the 60-minute here of the euro dollar, here's the trading channel that I took. Here's the pullback over here. And these back and forth moves are these impulse moves. Now, impulse moves happen on multiple time frames on multiple levels. So you'll get smaller impulse moves that are part of larger impulse moves. And this becomes really important when we look at target levels because sometimes targets will only hold the smaller impulse move and sometimes they will hold the larger one. Many times what happens is that if you see a break in buying within a larger impulse move, you might get an impulse move that stops as it hits the smaller one, pauses, and then continues to hit the larger one. So that's what I was looking at when this trade was under development. And when we go and look at this here, and look at how to identify where those target levels are. When we look at momentum, remember momentum was one of those keys that's really important to trade management. Well, when momentum on a breakout is comparable to momentum going into the zone of congestion, In this case, the zone of congestion is a base, but started out a little bit sloppy. So we're looking at this momentum going into the point at which the momentum shifts. And we're looking at that as the continuation move. So you can see that in this particular trade, the momentum was really similar. What that means is that my target is going to be based upon initially that first impulse move. So when it came up to that level, that's the level that I started to take some off of the position, because I figured based upon the momentum here and what was happening over here, that would be a good level that if we were going to see a correction, it could start at that point. And I was also a little bit concerned about how this breakout had developed in the first place, because it wasn't the ideal typical breakout that I like. It's slanted a little bit to the upside. And, here's that overall momentum for that slant. So you can see it was a little bit different from a traditional base sideways as a breakout. But like I said, if you wait for all the perfect conditions, you're going to miss a lot of trades. So, with time, you'll become a lot more comfortable with taking some of these that don't look like a traditional setup, even though the bones and the ideas and concepts behind the setup are still the same. And so this is still a breakout setup that is very typical, very similar to a traditional trading channel breakout, or even like a bull flag. It just happens to be slanted a bit. These happen a lot more often when you're, coming into a newer trend. So if this is coming off of like a major downside move, then this happens a lot more frequently. Now, so with that first initial target level, let me switch over here to the charts first and show you what I did there. So I'm going to pull up the charts here. Erase this. Oh, you can see a trade here. I'm stalking this the euro pound here. It's forming a little avalanche coming off of a 2B or 2T rather. But let's switch over to the euro dollar. And so we're actually going to pull up and look at the 120-minute here. And actually, I'm going to drop down and look at the 60 first. And we're going to look at how this momentum initially offered some resistance. So when I'm drawing these, what I'm looking at is the low to where you see a momentum shift. And then when we're looking at the breakout move, we're looking at where the momentum is picking up again. So at this point, you'll notice that I'm drawing a typical Fibonacci extension, but I'm doing it a little bit differently than you might have seen in the past, because what I'm looking at is this smaller impulse move and then comparing how does that move break out of that. So the screenshot that I showed you, I took as the trade was developing and unfolding. I took it as it was hitting that level. Let me show you that here. So you can see that's, where it's coming right off of that price there. And this is where I figured, okay, you know what? We're probably going to see some sort of a stall. On the 60-minute, you'll notice that it doesn't show that stall, but I want to show you what actually does happen at that level. So even though you can't see it on the 60-minute time frame, here's what's happening on the smaller time frame. And this is, let me scroll down here. I've covered up that chart so you can't quite see it. There we go. So it's a 2-minute here. And you'll notice that right as it hits that 100% level, that it stalls. And not only does it stall there, but it was starting to slow as it was coming into that resistance level. Another thing that I was looking at as that was hitting was that I was watching this action here. And you'll notice that this move here and this move here are almost measured moves exactly as well, and the momentum is the same. So even though it wasn't quite at that 100% level on that 60-minute time frame, I was getting a little bit nervous, because if this was going to stall it, this would be the place that it could stall it. So this became a level where on trade management, I decided, okay, you know what? I need to take some of this position off here. Now, overall, the momentum was still really sharp. and stronger than average, decent average. So it looked like, okay, when something is stronger than average, it's probably going to give me more out of it, even if it does it by changing the momentum as it goes to those higher highs. So this became the first place to take part of the position off. Now, when we go forward and look at how this continued to develop and unfold, we're going to look now at the wider measured move based upon the wider impulse move. So here's that second impulse move from the lows to the highs. Here's the smaller one here. You can see it was about, 2/3 of the larger one. And here again, this is where the breakout started and where we had the momentum begin. So you can see that it went right again into that 100%, which is the larger measured move. Now, in this case, we just didn't have that pause at that point on the 60-minute time frame where you could see the pause. You could see it on the smaller time frame. You could see it happening on the 2-minute. We just didn't see it on the 60-minute. And that's not unusual, but it also means that if it goes, really strongly into that 100% without the pause like it had in the initial impulse move, then sometimes it can go and retest those 100% levels a little bit later on, which is a good thing as far as trade management if you miss your exit. And if you mismanage the exit on the trade and end up having to hold through a pullback or through a correction, or maybe you had an exit on the books and you didn't quite get filled because it doesn't hit that 100% level exactly. So if you don't get filled and the momentum is stronger than average, you have a better chance of having a second shot of it coming into that resistance level. And here is the screenshot that I took today that shows you what actually ended up happening after this trade. So here is exactly what I was talking about, where because it moved quickly into that 100% level and it didn't have much of a pause that we could see on the 60-minute time frame, it went and retried that level. And what you'll notice is that in this case, it did it with shifting momentum. Sometimes it will do it with the same momentum and it will form like these V's and do like a momentum reversal at the highs that will lead to a reversal. In this case, we had a 2T that developed. So it had a little two-wave correction, and then we had a nice little move back up into slightly higher highs, just enough to flush out those previous highs. This wasn't a trade I caught, even though it was pretty textbook. I wish I would have caught that one. It's gorgeous. But the euro dollar has been trading really, really nicely. And you'll notice that it had a couple of great continuation setups. So we had, the first one was a nice little avalanche here coming off of that. And when you look at the target levels, what's really interesting, guys, is that I drew the Fibonacci extension, last week when I first gave this class last Friday. But these levels continue to hold. They continue to serve as support and resistance as long as we are dealing with this same trading channel. So when this pulled back and corrected, we had the congestion forming between that 38.2 and the 61.8 Fibonacci extension levels. This is a very typical level then for an avalanche to develop. So since this high here at the 100% is where the momentum began to shift, that is the high that you would still continue to use to look at the retracements. So this retracement in here, this is a really ideal zone to look for these avalanche patterns. And you'll notice that when the avalanche developed and followed through, that we also had almost identical measured moves on that. Actually, I'll go show you that on the chart so you can see what it looked like and how to draw those. So when we're looking at drawing the Fibonacci extension, we'll go from the absolute high. Let me clear this one here. And we'll go from the absolute high. And then I go to where the momentum begins to shift, because that's usually when you're looking at the continuation, and that can be where that next level is going to be. So just like we looked at over here, where I drew it based upon this impulse move here, this is where the momentum began to shift. So same situation here. This is where the momentum begins to shift. Now, on this one, what you'll notice is that this got off kind of a little bit of a murky start. It didn't start off ideally as the strong, solid continuation. It was actually a little bit early compared to some of the previous levels of congestion. As far as like the time development goes. And so this pulled back up into the channel here. And so when it offered the continuation, this is the level that I would then use as identifying where the target levels are going to be, because that's where we started to see a little bit of the more solid follow through on it. Just like here, where when it pulled back, I looked at, okay, how's the momentum and the impulse coming out of that? And so we're getting into a little bit of advanced trade management here when we're talking about this, but that's because, a lot of these things aren't textbook perfect for a lot of traders. And if you're not able to understand how to place these correctly where they're actually going to work properly, then you're going to miss out on a lot of the key signals. So just like when I drew the Fibonacci extension over here, where I went from the low to the high to where it first broke out, that's the same thing I'm doing here to get that momentum. And when you look at that then and look at, where it actually ended up falling into support, you can see that it held that 100% again quite well right at that level. And this is, really an important strategy with using these Fibonacci extensions. It's one of my favorite tools for trying to identify target levels because it does hold so incredibly well and allows me to put target levels on the books before those target levels would actually hit. So if I need to step away or I'm distracted by something, which happens more often than it used to these days, then I want to have something on the books that if it hits that, it's going to, trigger for me. And if something changes, like if momentum is changing as it's coming into those target levels, then I will change those, how I manage the position. For example, if the momentum continued to be more gradual, then usually like the 76.4% would be a good level that you would see support starting to hit. So going forward, we had another strategy that triggered here today, and that was another momentum reversal. So the momentum reversal in this case, let me clear this. Is based upon, here's our little two-wave correction off the highs, and then here's that momentum shift. You'll notice it looks really similar to the one that we had on the little 2B, which if I go back to the slide, I'm going to clear this. And we're just going to go back a little bit and show you that 2B here. So here is the little momentum reversal that triggered that 2B. And so we had that exact same strategy that happened here now on the euro dollar on the much larger time frame. So I'm going to go back forward. I'm going to leave that drawing up so that you guys can see it when we get to the correct slide. And what I love about the markets is that you really do have this back and forth action, where it really is a flow from one strategy to another. So when I'm working with individual traders and we're working at, building confidence, I'll usually start with one or two specific strategies and then go out from there. Because once you learn like one or two strategies, you automatically are going to start to learn the additional strategies that follow it. So if you're learning breakout strategies, for example, you're going to automatically start to learn reversal strategies just based upon understanding how target levels are going to hit and where those target levels are going to hold. So you can see that flow really well here on the euro dollar this last week, where it goes from that breakout to the 2T, to the avalanche, right into this momentum reversal. And even on the smaller time frames, we had some really nice setups here not very long ago where it came off of these nice resistance levels. But let's go and look at a little bit more of this. So what is next, when we look at where do you go here? So to recap, when we're looking at trade management, the first thing is we have to pay attention to having the correct entry and stop placement. We also have to pay close attention to momentum, and you have to be able to identify the impulse moves. So the next step is getting into greater detail in regards to the trade management. So I have a boot camp that is coming up here. We start on the 13th. I just wrapped up the market timing boot camp. So here's the second boot camp. Whether you participated in the first one or not, this one gets into some more advanced strategies like what we saw today, but getting even more nitty gritty. We will be looking at things such as, when the market is shifting, how to identify changes in where we need to move our stop levels, how to identify, when we might be a little bit early in a trade, how we can adjust our share size or our contract size to continue to hold on to positions or build into positions. The boot camp is going to run from December 13th to January 30th. It's going to be every Wednesday from 10 o'clock to noon. You can register for it at tonyhansen.com/manage. And you guys have a little bit of advantage over what the offer was over the weekend because you are current site members for mine. So the offer that I'm giving you guys is a third off of what they were offered over the weekend. So it's 4 weeks of live training, all is recorded. We're going to look at, when and how to enter a trade, when and how to add on to a position, when and how to adjust stops, including trailing stops, and when and how to protect your gains. So an example of that is the momentum reversal here today. So this momentum reversal that triggered this today on the euro dollar that offered the continuation, you'll notice that a traditional channel break entry would be that entry up there, the one that I have crossed out. So here's the smaller time frame. This is the 15-minute down here, and here's the 60-minute. So a momentum reversal, the way that you want to enter these particular strategies is to drop down to the smaller time frame. When you see these back and forth moves, I look for a break in the channel as it's going into that third low. And that will offer you a substantially better entry than you would have if you broke that overall channel itself. Again, you can notice that this stalled pretty quickly, just like we saw on the breakout slide that I showed you at the very beginning of the class when we were looking at a traditional breakout. When it goes from the lows and just keeps going through that channel to highs, it's really common that this only will give you if you're looking at like the breakout compared to what a stop would be, it would only give you like 0.75 return compared to what you were risking. Whereas with adjusted entries, you would take this pullback here and actually take the channel break from that pullback. And there's additional entry triggers within this level here if you missed that first entry. So let me actually show you that. We'll drop down and look at a smaller time frame here. So here's a 5-minute. So you'll notice that when this broke that channel, the momentum on that channel was really fast as it went into that. And that made it pretty tricky to get an entry right as that channel breaks. Because if it breaks right here, you have the risk that since it flushed to the lows, which the flush is really typical, it's basically just taking out previous lows. If it flushes to that lows though, you sometimes will get retests of those lows. So usually if it goes and flushes really quickly like that, and I'm looking for that channel break, this is again going into that third low. Maybe I can make this a little bit bigger so that that becomes a little bit more obvious. So here you can see that that's that move into the third low. And I'll usually then look for trying to get into it. If it breaks this channel really quickly, I'll look to try to get into it as it pulls back into this zone. So that's a little bit more of an advanced entry strategy. We'll be talking about that more in the trade management bootcamp here coming up. But additional ways that you can do that is to also look at things like these smaller corrections, and even this channel break here is very similar to what was happening on that original trade on the 60-minute time frame, where, like I said, if it's first coming off of an initial low, in this case we've got the two-wave move up in here, and it's coming off of a low from a strong move on the downside, then you'll often get this shifted channel where it's not a pure, it doesn't look like a pure base or a pure phoenix. A pure phoenix would look more like this, and then it would offer the continuation, or you could get the base that's a little flatter and offer the continuation. This is that same concept. It's just shifted. So you look for the pullbacks and congestions within this shift to enter the trade. And last case scenario is if you miss it because it's a smaller time frame, you can take that channel break. Because it's a channel break, that's actually part of a much bigger strategy. Those are the only times that I'm going to take a channel break, is if it's on a much smaller time frame where I really like that larger strategy. Otherwise, I have to get in on these pullbacks, these corrections that are within that channel. And so that gives you another opportunity. And that stop at that point would be under this low. So even though this might look sloppy to a beginner trader or a newer trader, once you get familiar with the fact that sometimes bull flags don't actually pull back, they can look more like a pennant, then it becomes easier and easier to start to take some of those trades. So it's really just a matter of, giving your exposure to increasing your exposure to different circumstances. And this is why when I work with traders, we usually work with just 1 to 2, there's my little guy, 1 to 2 setups to begin with, because we want to look at all the different variations of those setups. What are the different ways that they can form? How does risk change as they form, and where they form, and where to go from that point? So other things that you can use for trade management and to really increase your odds on trades are to add things like Fibonacci, and sometimes people will also use moving averages. Fibonacci is one of the only indicators that I use just because it holds so well and works so well. So when we look at, here's the Fibonacci fan based upon that entire upswing there. And you'll notice that when this pulled back and began that momentum reversal, it came right into the 61.8% Fibonacci fan level. And then it pulled into the 76.4. So this is important because that 76.4% fan level is probably my most favorite level to look for a pivot and to look for continuation. So if this was moving higher and based, I like them to base into the 76.4. If it goes, 61.8, it might be a little bit early. So time development wise, that told me, okay, you know what? This is really perfect timing for this momentum reversal here. And you can also continue to leave these on your charts to help you with target timing. So a typical momentum reversal, I'm looking at these levels of congestion and where movements happen. So the initial target level is based upon right here, which obviously it blew right through that level. And the next target level is usually going to be that kneecap right in here, that zone here. But the larger target level, and the main one for strong pivots, is going to be where that channel broke originally. And that channel level immediately straight across is going to be that third target level. So when you see my template for my momentum reversal, that's what the third target level is right here. And you'll notice that that's exactly at that 50% fan as well. So that, as well as the Fibonacci retracements, offer great levels to look for to help you identify targets as well. So this is the Fibonacci retracement. And basically what it is I'm looking at that main swing to the downside, again, going from where the momentum started to shift, heading into that momentum reversal, and looking at that as far as where retracement levels are. And you'll notice it's right where that channel broke. It's right at that 50% fan level, and it's at that 76.4% zone again. So you have a really nice convergence of all of these things happening at the same time. And dropping down to a smaller time frame, I'm actually going to have to go back to my charts here and show you what happened here. So here's what that looked like on the smaller time frame. Is it came up, it didn't quite hit that level. It had 3 waves of buying. So there was your trend exhaustion, even though the absolute target was a little bit higher. So at that point, I think, okay, I need to take off some of the position here. The momentum is still strong enough that it might retest the highs and give me, a little bit better of a test of that target level. But because of the trend exhaustion, that's the point at which things are likely to slow. And I'll widen this up so you can see that slow down a little bit better. Actually, maybe I'll just switch to a 2-minute and show you on the 2-minute. So here is the 2-minute. So you can see this a lot more clearly now. So here's those initial 3 swings. 1, 2, 3. And you'll notice that is where we start to see the momentum shifting. But when we looked at where the resistance was on the larger time frames, that resistance was here. So just like in the previous trade, this is a situation where I take off part of the trade, but I hold the rest and look for additional clues for turnarounds in the market. And in this case, we had a very similar clue where it has a 2-wave move to slightly higher high and shifts momentum. So whenever I have it coming into the target level with the trend exhaustion, and then I have another 2-wave move to a slightly higher high, that's it. I'm done with that trade, because at that point, it's going to be very, very difficult for it to break that level. Now, in this case, if you missed that target, it got lucky, it retested the target level, which again happens most often if the overall momentum is really strong going into the target level. But you don't always get that absolute retest. So you want to look for other things like the trend development. And, this is where getting into a lot more of that advanced trade management, it becomes really important. So over the next couple of weeks, that's what we're going to be focusing upon in the next boot camp, is we're going to be looking at how to actually manage these trades as they are not only starting to set up, looking at how to scale into positions, which positions you want to scale into, which ones you don't, which ones you just want to get into the entire position all at once, and look at how we exit the positions as well, and the different strategies for how a trade might look like one thing when it gets started and then it turns into something different. So other things that we'll be looking at during the boot camp are also going to be looking at trade catastrophes, so catastrophic trades. For example, when you have like a swing trade that you held overnight and it gaps against you, how do you manage that trade to mitigate your losses and even recoup some of the losses in some situations? So one of the days in the boot camp is going to be focusing upon that as well. And if it's a situation where you miss your target, how do you get out of the position where you've missed your target, where maybe it comes into a target zone, doesn't quite hit your target, now what do you do? Or if you just completely mismanage trade, you place your stops wrong, how do you deal with that at that point? So we're going to be looking at managing bad trades, I guess. Managing mistakes is going to be one of the sessions that we're going to be focusing upon. So you can sign up for that boot camp at tonyhansen.com/manage. Can you guys still hear me okay? Okay, perfect. So you can learn more about it, sign up there. And I also have an offer since you guys are all, current members. This is again, third of the price, or sorry, 2/3 of the price of what is offered to somebody that is not. And you guys have a free 30-minute private mentoring consultation with me. So most of the people that have signed up so far that I've talked to are doing their consultation after the boot camp, so that I can work with them on any ongoing issues. So you can sign up for the mentoring during the course of the boot camp, or you can sign up and have it with me after the boot camp is over. Basically, anytime. You can even have it a few months after the boot camp if you want time to kind of digest things and review the boot camp a few times before we get together. So that is another thing that you guys will get as part of the boot camp. So you can register for that again at tonyhansen.com /manage. Make sure you use this link because this is the link that has it for $197 versus the $297. And if you have any questions for me, email me at info@tradingfrommainstreet.com. I will put that here in the chat box. Info@trading. It's a little bit long. So there you go. Any questions can go there. And does anyone have any questions today? Let me look here and scroll through the questions you guys have asked here. I think some of them I've answered throughout the course of the class. Oh, great, Karen. I look forward to seeing you again next week. Do I only use the 60 or 2-minute chart for day trading? Absolutely not. So when I'm looking at, time frames that I'm trading upon, I'll use many multiple time frames. Usually my scanning page, it will look like where I have like the smaller time frames on the top, bigger time frames on the bottom, and whichever time frame I happen to see a strategy developing on, that's where I use the focus. So, for example, the euro dollar, it's been on the 60-minute this week. But sometimes I'm just focusing on like the NQ and I'm looking at smaller intraday time frames. And for those, then I'm not going to be, paying as much attention to the larger time frames. But I drop down and use the smaller time frames based upon, for timing the entries and for timing the exits. So what happens is I'll use a bigger time frame like the 60-minute to actually see the trade developing on. And then I drop down to a smaller time frame to manage the entry. Then I'll go back up to the larger time frame to look at the target levels, and then drop down to the smaller time frame again to manage the exits. So it's a little bit of back and forth action. We'll see a lot of that as throughout the course of the boot camp, going back and forth. I've even, sometimes I'll have traders go down to even smaller time frames that they were looking at than they were really paying attention to, just to manage the exits and entries even better. So, huge fan of using multiple time frames, but it's really important not to get stuck on the smaller time frames. So if you take a trade that is based upon the setup you see on the 60-minute time frame, you want your target levels and general trade management to be based upon that 60-minute time frame, but then you use the smaller time frames like a 5-minute chart to actually time like the specifics of the entry and the exit. So hopefully that makes sense. Yes, Lydia, this will be on replay, so you can definitely go ahead and save this. I'm going to probably have this out to you tomorrow, hopefully by noon tomorrow. So it will be available to everybody that signed up today. I know there were a few people that weren't able to make it, and they wanted to make sure that they get the recording as well. Okay, okay, let's see. For swing trader, other than a daily and weekly chart, what other charts do I look at? So for swing trading, I'll usually glance at a monthly chart just to see like where it's taking place in the larger time frame, but I'm really dropping down and using 120-minute, 60-minute, and 30-minute, and usually I'll kind of go back and forth. So like let's say, let's pull up a chart here. So let's say I'm looking at like a 60-minute and I want to kind of get a better feel for it. So I'll just squish up the charts and it kind of gives me the view that I would get if I was looking at like a 120. So it's a great way to, kind of go and look at a little bit more of the detail and then kind of back up again and look at the smaller time frames to get, a feel for what's happening right now. And that is, what I will do with those. Usually for swing trades, I will sometimes drop down to even a 15-minute or a 5-minute if I'm seeing something that is starting to develop on the smaller time frames, especially if it's like a breakaway gap and I'm looking for a swing trade on a gap trade. Then I'll use a lot of the smaller time frames for entry because a lot of those entries take place within the first 15 minutes of the day. And sometimes I'll use like even 25 tick charts or 2-minute charts just to time those. So it really depends on the type of trade as well. But yeah, definitely at least you're going to want to look at the 60-minute intraday if you're swing trading. All right, guys, I'm going to go ahead and stop the recording here and save this. And I know there's a couple of other questions on just random stuff. So I'll get to those here questions in a minute. But let me save this recording for today. I'm going to show you guys again that link here for the boot camp. So it's tonyhansen.com/manage. And we do start a week from Wednesday, 10 a.m. on the 13th. So make sure that you are registered well ahead of time. And we will, yeah, I look forward to seeing, I know I see a lot of you guys here that are already registered. So it's great. I will see a lot of you guys coming up. Yeah, and if you've already registered me and haven't set up the private session as well, contact me for that. Anybody that I haven't heard from by the time boot camp starts, I'm going to be contacting myself. How many hours of instruction will be in the boot camp? So it's 2 hours minimum every day. A lot of times I'll go over a bit. It's never less. So it will be at least 2 hours every day. So we will be going from 10 to noon on every day. I usually give half an hour or so of the market being open for anybody that needs to, deal with any open positions, including myself, before we go into the boot camp. So we start half an hour into the day. Every session is recorded, and you get a copy of the recording usually within 48 hours so that you'll have time to review it over the weekend ahead of the next upcoming session. And let's see here. How many days are in the boot camp? So it is 4 weeks, so 4 days. So you're looking at a minimum of 8 hours of training. My guess is that it'll be closer to 9, maybe a little bit more. And it's every Wednesday. You're welcome. Does anyone have any other questions on the boot camp at all? Lydia, if you send me an email address, I will get you hooked up with that course that you bought. We have some traders in here. They've been with me for years and purchased a course a few years ago, lose their passwords, that sort of thing. So the course is still up. You can still access it. You just might have changed your email. So we'll get you hooked back up there, Lydia. What instruments do I look at during the boot camp? That's a good question. So I cover a lot of different markets. Personally, I do Forex, futures, and stocks for the most part. But we'll be looking at a number of things, everything from gold, bonds, uh, any number of markets, really. The great thing about my style of market analysis is that you can take it and apply it to any market that you're trading and any time frame you're trading. So literally, you can be trading stocks for years and then suddenly get it in your head, you know what, I want to trade Forex. Maybe you were swing trading stocks and suddenly today you want to day trade Forex. Well, you can take exactly what you are taught on the swing trading and apply it to Forex. So it's literally that easy to make the switch, as long as you learn like the basics of your how to enter and exit those trades, that are specific to that particular market, trading contracts versus shares, that sort of thing, then everything else is really just the same. Am I going to do a Forex boot camp in the future? I have done a Forex boot camp in the past, and yeah, I will definitely look forward to doing another Forex boot camp in the future as well. That will be on the agenda for next year. So another person asked, when am I getting my trading room going? So we are just finishing up the final stuff on the new site. And as soon as that is all up and we have everything transitioned, then I will be getting the trading room up and running. So hopefully that will be here really, really soon. Will we be taking real trades that we can follow along and maybe take also? If we see something develop, then absolutely yes. It really depends on what's happening in the market that day. So the goal will be to, each session I usually focus on particular topics, and we go into those topics in detail, and then we look for things that are happening in the market that type of thing applies to. So like if a trade is developing in the morning, the day of the boot camp, and maybe it's like a momentum reversal, and let's say we were looking at how to enter momentum reversals, then we might skip ahead, and since a momentum reversal is now forming, we'll follow that from start to finish as well. So, whatever we see developing during the course of the boot camp, that's going to be something that gets integrated into the boot camp. Also, we will be looking at some individual trades from some of you guys that you have taken and are in, to look at, how would trade management apply to these trades? And we can look at trades that I'm in as well. How am I looking at, what am I looking at for targets and why? And I'm going to be trying to take some trades that are on the smaller time frames throughout the boot camp so that we can see those developing and unfolding. What days and times do I plan on having my own trading room open? So that's going to be on Monday, Tuesday, and Thursdays. Mondays is going to be a class day, and it's going to be over noon. We'll be having a class on Mondays. And then Tuesdays and Thursdays, it's going to be from half an hour before the open, going into a midday, for both of those 2 days. And then, of course, we have Forward Focus on Friday at noon as well. And so that's more the outlook for what's ahead in the upcoming week. Does anyone else have any other questions regarding like the boot camp or that sort of thing? Do you recommend we use TradeStation? I think TradeStation's a great platform. It's not the only great platform out there. So, you can look around if you like, if you're newer to trading and looking at switching, you can look at TradeStation definitely as one of them. A lot of traders will use other things though. So I don't think that you have to be necessarily on TradeStation. Of course, it will help with looking at my charts and using the different tools and techniques, but it does. I don't think it's like a must-have. How do I sign up for the trading room? So the trading room will have a sign up as soon as we have everything tested and ready for it. So I ran a trading room for 15 years, starting back in, let's see, was it 98, I think? was when I first started Trading Room. So ran it for about 15 years, took a little bit of a break from doing it every single day when my son was born. Um, so just getting back into looking to do it, part-time so that you guys have the opportunity to learn live as well as, do some trades with me also. So we'll be focusing primarily on, we will be doing futures, forex, and stocks. And the stocks will be everything from day trading to swing trading. So the big thing with the trading room is not really necessarily using it just to take like the same trades that I'm taking, but to use it as an educational instrument as well. So maybe you don't take Forex and I'm taking a Forex trade. Well, you're going to learn from following how I manage that trade from start to finish. You're going to learn a lot about just market analysis and trade management just from doing that. So even if they're not a trading vehicle that you trade, then it's still going to be something that is going to be incredibly valuable. I know when I first started trading, I only traded stocks. That was all I knew back then, and really it was the only market that people were really focusing on for online trading. Um, then futures trading became a little bit more regulated and just kind of naturally transitioned into doing that. And then Forex became more regulated. And so I added that on. And, now we'll see how things go with the Bitcoin. That's like kind of where Forex was 10 years ago or 15 years ago, I guess. All right, everyone. I know there's some questions here on like individual stocks and what I'm thinking on individual stocks. Drop by Forward Focus on Friday because that is where we will be looking at the overall market and looking at a lot of individual things like the different currency pairs, what's happening in the currency markets, individual stocks, especially, longer term. So Forward Focus is at noon on Fridays. It is something that you guys should be able to all have emails to it. Let's see, trying to think where. I don't think I have a quick link for you in here right now that I can just grab for you. But if you are not in Forward Focus already and are interested in joining Forward Focus, you can email me at that info@tradingfrommainstreet.com and I'll get you signed up and in there. So Forward Focus is free and it's every Friday from noon to 1 o'clock. I'm just scrolling through questions here. Okay, if we initiate a trade during the Wednesday boot camp or the trading room and are still in it after the room or class is closed for the day, will there be any help for managing and exiting those trades? Absolutely. So the trading room actually comes with daily videos that focus on things that I'm following for those days. Monday through Friday, there's premium videos as well as any updates for any like pertinent information. So you will receive all of those as well. So in addition to, what's happening live, that's also another thing that you'll be getting. Um, let's see. I think that answers the main questions you guys have. And again, for any additional like stock specific stuff, join us on Friday because we have a lot of time that we can get into that. All right, everyone. I'm going to wrap things up here tonight. Thank you guys for joining me this evening. I look forward to seeing a lot of you back here for the boot camp next week. And the rest of you, hopefully I will see you on Friday as well. So everyone have a great remainder of your evening, whatever you have left of it here. it's getting kind of quiet in this place, so I think people are starting to pass out. So have a wonderful evening and a great remainder of your trading week, and I'll see you guys soon.